Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Home improvement giants Lowe's and Home Depot recently reported their first quarter results, and they both reported revenue declines between 4 and 5%. Caught a lot of people off guard after the big growth that both companies have been reporting, especially when we consider how many people are now basically locked in the home that they have because of ultra low interest rates from refinances and houses that were bought in 2020 and 2021. Are we overlooking one really important number that might be the reason people aren't spending as much at these home improvement retailers and from some of the companies that manufacture the products that those companies are selling? I'm Jason Hall. This is The Smattering, and I've got Tyler Crow here with me, and we're going to talk about the HELOC and why this might be a number that we just completely missed that says a lot of these companies might be struggling going forward. Hey, what's up, Tyler?
I'm doing pretty good, Jason. The fact that we're going to open on HELOCs, I mean, talk about an interest getter, baby. We're talking some hot takes right now.
All right, wake up, people. Wake up. You're still with us? Seriously, it sounds boring, but it's really important because if you think about Home Depot and Lowe's, and you think about James Hardie Industries, you think about TREX Company, a company that I love, a lot of these companies make products or sell products that are big ticket items. If you go to Home Depot or Lowe's and you want to get an appliance, you probably have some special store financing. But if you're going to build a deck and you're going to spend $10,000 or $15,000 on a deck, you're going to renovate your kitchen, you might be going to your bank or going online to get a HELOC, a home equity line of credit, to pay for that big ticket product. Maybe that's just not as affordable for a lot of people as it was a few years ago, Tyler.
I started thinking about this a little bit more recently because I was looking at some building product company earnings and guidance for the rest of 2023, and a lot of them were really predicting down years in the refurbished market, which to me seemed a little off because as we discussed earlier, we were like, wow, all these people are locked into these mortgages and refinances at really low rates. They're not going to be going anywhere anytime soon. And so kind of the thesis was they're going to spend on their existing homes, right?
History backs that up, Tyler. That's one thing we've learned is that when housing prices do increase sharply and when inventory is low and it's harder to buy a house, people spend more money on the house that they have.
Here's where it gets challenging though. Like you said, if you want to make a major change to that house, you're going to have to find some line of credit to do it. And right now, the average interest rate on a HELOC is 8.16%. So great that I have 3.2, 3.3% 30-year fixed mortgage. But if I have to slap an 8.16% HELOC on top of it, it all of a sudden makes that look less attractive.
Moving from the interest rate itself to the actual numbers on the street, there's a piece of data that's reported, which is the net percentage of domestic banks reporting stronger demand for HELOCs. And that number is negative 23%. Basically, we're looking at a huge collapse in demand. And we're talking about levels going back to prior to the pandemic back in 2019, right? So we're seeing the effect of that interest rate as we would expect it. Tyler, I want to take this one step further and talk about forward guidance that we're hearing from some of the companies in this space that maybe indicates that the next few quarters, next year or two, could be a struggle. What are you seeing out there?
Pretty much across the board, any building supply company that I go to, I'm finding something that says some sort of decline either next quarter or throughout the rest of the year. Louisiana Pacific makes a lot of kind of engineered fiberboards and engineered plywoods, a Berkshire Hathaway favorite actually. They're expecting the second quarter to be down as much as 5%. Simpson Manufacturing, they're also projecting declines in margins, decline on sales. James Hardie, that was actually one of the bigger ones. They were projecting as much as 10 to 12% declines, specifically from the refurbish and rehab segment of its business. Even TREX, to a lesser degree, same thing, looking at rather large declines from what was a couple bumper years.
I think that's an important thing to mention right there. And I want to hit on TREX for a second. It's a lesser degree because this is a smaller company and it's a more specialized product. That's not like Simpson, where their products are used across commercial and residential construction, renovation, new construction, all of those different markets, right? Where they have lots of customers doing lots of different things. TREX is largely for residential decking. There's some commercial decking that it's used for, but we're looking at about an 18% decline. Their projections for the midpoint of guidance for the second quarter is about an 18% decline. And this is getting into their peak time in the spring and summer. That's deck building season. So that's when they see the most demand. But again, your point, and I want to hit on this because I think it's important for some context, because the last thing I want to talk about is our view looking forward, whether we see any opportunities or not. TREX, again, revenue down about 18% at the midpoint of their guidance for the second quarter, but from an absolute bumper year. Last year, the beginning of the year was great, and then things really fell off towards the end of the year as interest rates started to rise, the pressure of inflation, people started spending less money on decks, and the distributors cut way back on their orders and focused more on depleting inventory, and less inventory build happened over the winter, getting ready for this peak season. But again, you look at its results compared to pre-pandemic, this is still a really healthy business, and their revenues are good. Their margins are down a little bit, but partly because they're expanding, they're spending a little bit on future capacity, and it's adding to their operating expenses some. But my observation is looking at this is to think kind of counter-cyclical. The business isn't necessarily going to be great for some of these companies in the near term, but if the market gives you an attractive price to buy one of these companies, and you're thinking about a multiple year horizon across the entire cycle and thinking about the midpoint of the cycle, I think a company like TREX is actually really appealing right now. Do you see any opportunities?
Specifically at this moment, I would actually lean towards no. This is one of those,
Yeah.
I just kind of want to sit and wait and see what happens. Like you said, we've had this huge pull
Kind
forward.
of in the in-between where the market hasn't really necessarily fully valued the downside of the cycle and created the best opportunities to buy.
In that sense, I think I want to sit on this for a few quarters. I want to watch what happens. I want to see how this kind of shakes out for all of these companies before I make any big decision. But the most important question I have for you, and this is anecdotal homeowner question. I'm coming to visit you this summer. Am I going to be slapping down a Trex deck or hanging hardy plank siding on your house when I get there?
I will say that there is a distinct possibility you could be helping me lay some Trex decking. That is one of our priority projects. We have decided to hold off on the kitchen because it is a big ticket item. And honestly, the interest rate on the HELOC that we thought about, a little bit higher than we want. So we are one of those anecdotal customers that is holding off right now.